Apes and apettes, welcome back to the channel. This is a video that I am very excited about and will make you millions of dollars throughout your investing lifetime if you learn the macroeconomics about what we're going to talk about here in this video, including what the Fed says and does, because the Fed is king in the markets. They help the markets a lot in good times and they hurt the markets a lot in more bad times. And I say that in air quotes because bad times for the stock market does not always mean bad times for everybody if you know how to maneuver, if you know how to trade options like we do. In the pinned comment you'll find the link for the buy and sellers. Join a great community over there. That is the sponsor of this video. But getting back to the point, we need to go over what the balance sheet runoff actually means, how long this will last, and what kind of effect this will have for AMC and the broad markets. But first and foremost, I do want to point out that there really is two different ways that we could short squeeze, and I want to get your guys' feedback on what you think, and then I will give you guys my opinion on this. So the two different ways we will squeeze or go through the Moass is either the markets rally and shorts cover because of momentum after a bear market is ending, or the markets go down further and we Moass like we did in 2008. And it's pretty clear what would cause us to squeeze on both sides of the spectrum here. If AMC falls into the ground, if the markets are in the toilets, hedge funds have less money to cover on those short positions, and even a small catalyst like we seen during 2008 can send a stock upwards in a very rapid pace. As short sellers, you can imagine this like short sellers trying to run on top of each other to get through an exit, right? In the movies or something. That's what happens during times of less liquidity. Short sellers are jumping over each other to cover on those positions, driving the share price through the moon. The other aspect of this is not something that I believe with or reside with all too much, and that is a short squeeze happening just from a secular rotation back into small and mid cap stocks and shorts covering by that sense. Why I don't really agree with that is because I think that would be short lived. I think if you see a momentum move back into AMC from shorts trying to cover with a little bit of FOMO buying here and there, in this day and age of the markets, I think it would be short-lived. And I don't think the markets are just going to rally back up. I think it's going to be a very, very rocky year because, like we're going to talk about here in this video, people know what to expect when the Fed raises interest rates 0.25%, 0.5%, and they do this a couple times throughout the year. So that's not really why the markets are even selling off. It comes down to the balance sheet. Nobody really knows what is going to happen after you take trillions of dollars of liquidity out of the system. This did happen in 2018, 2019, but they only reduced the balance sheet by less than $1 trillion. By most analysts' calculations, the Fed has to bring the balance sheet down about $3 or $4 trillion at the bare minimum. So we're going to dive into all this information. If you guys are new to the channel, my name is TCI. We keep you guys updated on macro trends, on anything that'll make you guys money with AMC or any other trade or investment. Sometimes it's not highly liked. Sometimes it is. Sometimes it makes you guys a lot of money. Sometimes it does not. But that is the glory of investing. So give that subscribe button a big fat click with your mouse or your finger if you're on your phone. Like the video. Comment down below. What is your take? How do you think we are going to short squeeze? Do you think we're going to short squeeze by the markets falling into the toilet and then a catalyst? Or do you think we will short squeeze just from a secular rotation back into these small and mid cap stocks? And that is very important once we get into the second half of this video, which is going to be the balance sheet running off and how long this could take to see a full-blown secular rotation back into the small and mid cap stocks. Now, if you guys want access to all of those trades in real time, and you guys, if you need somewhat of a mentor, I want to get as many people into options as possible because options literally give you options in life and options in your investment strategies. So you can make money on the downside or the upside, or if the markets don't do anything, by trading options with different kinds of strategies. So check that out as well. Now, first off, before we get into the whole balance sheet runoff, how long this sell-off could actually last, how long the markets might be down off their all-time highs. This is from Fed Kashkari. He says it is time to walk the walk and backs a March rate hike. He is one of the most dovish Fed board members. He believes inflation will moderate halfway through the year in 2022, and then the Fed might not have to act so aggressively, but he is calling for a March rate hike to make sure that the investment public, the markets, the government, everybody knows that the Fed is serious about what they say and they are going to rein in inflation. Just by doing that, he says in his words that that is going to cause inflation expectations to go down quite dramatically, thus reducing inflation, because inflation expectations are more important. Throughout 2020, since the first stimulus package was passed, people have been calling for high inflation. So what do business owners do? They start raising prices because people expect inflation and they expect prices to go up. So by doing that, by having that inflation expectation, they raise prices and actually cause real inflation. That is why food prices are so high. That is why everything is higher or more expensive than it was just 2 years ago, or just in 2020, or even earlier in 2021. I just went to the grocery store last night and everything is super expensive. I got like 10 items, 15 items, and it was $100. Ridiculous. But that is the scoop on that. So that is why we are going to be so data dependent heading through the next couple of weeks and the next couple of months. The next big day to be watching for is February 10th. If inflation for whatever reason comes in lower and we see a decrease in inflation, we will probably see the markets rally, because if inflation starts to go down, the Fed does not have to be as hawkish, and it's already priced in that there will be a rate hike increase in March. So if we start to see the data reflecting to the downside, the Fed does not have to act so fast as far as raising rates. And the next big meeting, the next big Fed meeting to be watching for is going to be the 2-day FOMC meeting. That is March 15th through the 16th. The 15th meeting is for, what they're going to do next meeting. Kind of confusing there. Bear with me. The 16th is the actual press conference, as you can see right here. That is where Fed Jerome Powell will either upset the markets a lot or make them very happy. Good news is, as we've been falling, the markets have been pricing in a very hawkish Fed. So if he is more dovish and not as hawkish, which I doubt he will be, then the markets could rally off of that. Odds are the markets do fall for an extended period of time. And we're not talking about a couple months, go back to all-time highs. This is not what I'm talking about. Like I've said for a while now, I do think corporate earnings will go down in 2022. So it's going to be quite bloody, for lack of a better word. When you're looking at 2021 revenues compared to 2022, it's not going to be so hot. So those companies that are even doing well on a fundamental basis might not do as well in 2022, thus bringing down the value of the markets. Now, what we really need to talk about is going to be balance sheet runoff and the Fed balance sheet, because this is the Fed balance sheet right here from 2008, basically throughout the global financial crisis. We had very little quantitative easing throughout 2008, and then we started to get a lot of that once things actually started to hit the fan. Shit hit the fan, and we've seen the balance sheet go from about $800 billion all the way up to $2 trillion, come down a little bit, but gradually continue to go up until we did flatten out at about $4.5 trillion throughout basically 2014 throughout until about 2017, and then the Fed started to let their balance sheet run off, and they only went from about $4.5 trillion down to, at the lowest level, $3.7 trillion. So only about $800 billion was reduced from the Fed's balance sheet. And then throughout 2020, the rest is history, going from $4.1 billion all the way up to $7.1 billion, and has continued to climb now to almost $9 trillion. So this is the Fed balance sheet, and this is what everybody is concerned about, is because we have never seen the Fed reduce their balance sheet besides down here in 2018 and 2019. And take a look at what happened to the markets during that time. It was not a pretty time to be investing in the markets. Markets sold off in 2018, rallied back up, hit all-time highs just barely, and then came crashing back down. And this was almost a 30% crash in 2018. So, well, early 2019 and late 2018. And actually, the day before Christmas was very bad in the markets. So that is why the balance sheet running off is scaring a lot of investors. And considering how much we have to actually reduce the balance sheet, it's definitely scaring investors for probably all of the right reasons. But what is balance sheet runoff and how does this actually happen? So balance sheet runoff. For a bank or lender, portfolio runoff can occur when payments are made on fixed-term loans without further loan volume generation. Banks can experience runoff when individuals and businesses withdraw capital to invest in other high-paying investments, thereby reducing the bank's capital. And if that does not make sense, it's basically like the Fed bought 2-year treasury bonds back in March, so a lot of those are going to start maturing in March, and a lot of them do mature all of the time, on the long end of the curve, on the short end of the curve, whether it's 2-year, 5-year, 10-year, 7-year, does not matter what year it is. They expire all the time or mature, and then the Fed, what they'll do is they'll reinvest those profits back into more bonds. So it keeps the balance sheet neutral and actually helps to raise the balance sheet because they're getting paid out this interest. Now, what balance sheet runoff is when those bonds start to mature and they don't reinvest that money again. So what that does is that causes the bond yields to go up, thus causing real interest rates, the rates that you or me will pay on such things such as car loans, house loans, refinancing things. It makes those rates go up, thus reducing liquidity, because now if you need to get a loan, you have to pay more money to the bank to do so, and that does have a big impact on the markets. But as you can see, and what I said is that we have no idea what it's going to cause if you try to get the balance sheet down to like $6 trillion, which we're probably going to try to get the balance sheet down in between $5 and $6 trillion. That's more of a healthy, gradual growing balance sheet. And that's going to freak out investors, just like we have already seen. And that's why the markets are so vulnerable and pay very close attention to the words balance sheet in all of these reports from the Fed and the questions that Fed Jerome Powell did receive. And that is why inflation data is going to be so important, because the Fed does not need to reduce the balance sheet as much or raise interest rates as much if inflation is under control. Now you add my thesis on top of this with the fact that earnings are going down. I think the Fed will actually pivot once they realize, hey, we might start to cause a recession. Inflation is coming down. I think they will pivot and stop the balance sheet runoff and stop raising interest rates as aggressively or in general. And that's when you will ultimately see the markets get a green flag, good to go. But inflation, in my opinion, is not going to start heading down in a meaningful way to deter the Fed from raising interest rates, doing this balance sheet runoff, taking liquidity out of the markets until at least halfway through the year, if not the third and fourth quarters of 2022. So that is why it is so important. But how you guys can actually trade this and make money off of this is by anticipating what the markets are going to do, as well as trading bonds. Because when the Fed lets the balance sheet run off and they raise interest rates, that makes the 10-year treasury yields and the other bond rates start to go up. That means TLT, the 20-year treasury bond, that's the ticker, TLT, that will head down. So once that starts happening, and if we get any surprises from Fed Jerome Powell, you can see monstrous 10, 20, 30,000% returns playing TLT to the downside in this case, or to the upside once shit hits the fan, like I did back in March. So this is very important. But mix that with the amount of margin that we are seeing. The margin debt in December is at $910 billion, including securities-backed loans, SBL loans, that are not usually reported by the largest banks. That's estimated in between $500 billion and $1 trillion. You're really looking at a margin situation that is incredibly high, and you've already started to see some margin calls, but a lot of people have not been margin called just yet. We have only seen the margin debt go down about $25 billion since October. So not even a fraction of what we are likely to see once the markets do come down. So hopefully that provided you guys some context for this situation. As far as what I think will happen, I do think the markets are going to head down, especially once the Fed starts to run off the balance sheet and really suck liquidity out of the system. And then you see the Moass once AMC is at the bottom in the dirt, once the markets are in the dirt, which keep in mind, I don't think AMC is going to fall all too much lower because we've already fallen a lot. I think we'll really balance out around $15. Worst case scenario, $10 per share if the markets do start to just crater 20, 30, 40, 50%. That is my take on the situation. As far as when to expect a rally, it's when the Fed changes course in Q3 or Q4 of 2022. In the meantime, if you guys are long-term investors in AMC or other stocks, buy the dip. If you're a long-term investor and you don't need money for the next year, keep buying your favorite stocks. And also make sure to join us in the options trading community. Great community to be involved in. We can somewhat guide you guys, mentor you in different strategies, ways to play the markets. Obviously not your financial advisor. It's not advised you take the same trades that I do, but you learn the strategies that are involved and you can come to your own conclusive decisions when you are ready to. Love and appreciate you guys. Thank you for watching. I will see you in the next one.